Joining us for a further look on what's playing itself out on that market scene is independent analyst Jimmy Moyaha. Jimmy, always a pleasure. Good afternoon.
Good afternoon, Lutando. Thanks for having me.
All right. I think we're okay today in midday trade, I'd say. I did say more green than red. Let's talk about what we are contending with today.
I think there's a lot of uncertainty that still sits in the market, and you're seeing that from investors, you're seeing it from analysts as well. There's a lot that goes back and forth. 1 week we're having a good week, the next week we're not. 1 week we're expecting non-farms at 187,000 jobs, we get it at 330,000, and you're seeing that today alone, dollar strength is playing itself out. The rand is back towards 19 rand. The gold price has weakened to about $2,030 an ounce, giving up about 1% there as well. If you look across at global markets, equity markets, Hong Kong was up about 4% in traders at some point, with Shanghai not far behind, up about 3%, whereas you look at European markets and the South African markets, as you just mentioned, they're marginally flat or marginally in the green. So you are seeing that markets at the moment are still trying to make sense of the developments that are happening around the world, but more so than that, trying to see how those developments are going to underpin 2024 and what we're set to expect for this year.
I must also ask you, are we at a place where we are accepting that the Fed is still a little bit more hawkish than what we'd like? You know, markets like to look ahead. I know they like to price ahead, Jimmy, but the Fed still sounds hawkish. They're still looking at data, and they haven't been able to commit to a time on interest rate cuts because they're looking at the data.
So there was a time where we had a bit more certainty to say, okay, there's a lot of dovishness coming in from November going into early 2024. This makes sense and all of that. I think the numbers coming out now, the data points that start to come out, but there's always a lag with data, right? So from when a decision is taken by any Fed, whether it's South Africa, whether it's the US, there's always a lag to see it fully in effect in the economy. And the jobs numbers, the latest jobs numbers, surprising to the upside, unemployment coming down in the US, the Fed is saying, hang on, we don't want to get this wrong. And this is something that Fed Chair Jay Powell has been on about since the start of his tenure. He said that the team has learned from the mistakes of the 2008 financial crisis, and they will not be making knee-jerk reactions to react to things until they feel that they have a certain degree of certainty. And that's why you're starting to see, even now, you're still seeing that bit of a yes-no kind of approach, up, down, hawkish, dovish, flipping between the two, is they don't want to make the incorrect decision. And I think every year has been a new factor that they've had to contend with. Elevated inflation, COVID-19, elections in 58% of the GDP of the world. So there's always a new factor, and for them, it's more about wanting to get it right than wanting to get it horribly wrong. And what we've priced out now is we're not going to get rate cuts from Q1. We might not even see rate cuts in Q2. But then the market is now saying, okay, that means Q3 and Q4 are going to be accelerated rate cuts, which again, that is our assumption. That is not what the Fed is looking at. The Fed also still needs to balance things around jobs and unemployment and the strength of the US economy to avoid tipping it into a recession, because that's now a new factor that they need to worry about too, to say, okay, we're going to go dovish, we're going to reduce interest rates, but at what point is reducing going to trigger inflation, trigger a recession? And when we then look at the rest of the Fed's balance sheet, do we now have to think about conversations around quantitative easing? Do we have to have those? Because that's a whole other ball game that needs to be brought into the fold as well. So the Fed's not in a rush to make the decisions because they don't want to make incorrect decisions.
So precision over speed, and I'm happy with that. Also, let's talk about China. Every once in a while, we hear of efforts to stimulate the economy, and we think this is going to do it, and then data comes out and it's like, okay, that didn't do it. Now we know that we have the government. They're basically trying to boost the stock market. They've gone on to acquire shares there. Is that working, Jimmy? I see Process and Naspers out today, so I guess the markets are loving it. But what does that mean?
The Chinese story is a difficult story because if China hadn't meddled from a policy point of view when they did, the markets would be looking at Chinese markets very differently. Now investors are looking at Chinese markets saying, yes, these are attractive numbers. Yes, they might make sense. Yes, you probably will hit the numbers and the growth, and you might still be the leading growth story of 2024. But the reality is, if we're going to pump all of our money into Chinese stocks, what's going to happen when the Chinese government comes out with a new policy directive? The policy directive, the most recent one that came out, was in November, December, around the tech companies being limiting the revenue that tech companies can make in online sales. Now, that kind of sweeping statement is not a free market, and it doesn't encourage the investment community to say, oh, our funds are safe there. The last thing an asset manager wants to do is allocate funds into an emerging market and then have that emerging market not perform well, not because the market is not well, but because it's been meddled with. So I think the Chinese government and the Chinese economy needs that reassurance that, okay, you plan to stimulate, you plan to provide stimulus into the economy or into the markets to ensure that growth happens, but are you then going to take a back foot? And because remember, the initial reason why the meddling happened was the Chinese government felt that the Chinese companies were making too much money. The Chinese billionaires were too wealthy, and it was about wealth distribution at some point, and they meddled in for that reason. So now, if we start to see a resurgence or success of Chinese economies, are they at danger or at risk of the government meddling again? I think that's a bigger concern than us seeing whether or not China can hit 2%, because we know for China that's a very reasonable number. We know 3% is very possible. So there are numbers they can hit, but I think the skepticism around the interference is weighing a lot on that.
Now, keen to get your stock pick for today. It's all we have time for, Jimmy. It always feels like our time isn't sufficient. But let's talk about which counter are you loving amidst all of this, because it is a rather volatile environment still.
It's extremely volatile, it's extremely dangerous, and even with the stock picks, I've seen a lot of picks. I mean, yesterday's ABSA pick was on the safer side, looking at defensive stocks and that sort of thing, and there is rationale and logic for that. But it is also one of those times where if there's opportunity, you might be benefiting from holding out with a bit of drawdown, and that's kind of how I've thought about my pick. My pick is Sasol, sitting at 155 Rand at the moment, down from 165 Rand where I initially thought it would turn from. Still further downside, could potentially come down to 135 Rand. I don't see a likelihood of it coming down to below 100 Rand and sustaining below that level. So at 155, 160 Rand, where you still got a 10% dividend yield, which is going to come under pressure now with the latest set of numbers, obviously. And if they can maintain that, and we can see some volatility on the upside on oil markets, that could be a good windfall. I mean, from 160 Rand, you've got targets at 200, 300, 500, even 700 Rand from 2015 highs, which, yes, realistically, we're not going to get there anytime soon. But 150 Rand at the moment on Sasol looks very attractive.
Fantastic. Always a pleasure having you. Come back for longer, Jimmy. That was independent analyst Jamie Moyaha.